Are you tired of sending $50,000 to $100,000 to the IRS every year with zero control? This might be the most important video you'll watch all year because I'll be showing you how to put that money back in your pocket legally by using real estate without quitting your job. By the end of the video, you'll know how to cut your effective tax rate and boost take-home pay this year. Front load big deductions so you keep more cash now, not over 27 and a half or over 39 years. Turn rent-ready properties into tax shields you can use against your W-2 income. Build an audit-ready plan that holds up. Redirect tax dollars into assets, such as real estate, investments, and more debt paydown. Most importantly, I'll give you the two cleanest lanes that make this work: short-term rental and reps status, also the real estate professional status. The exact steps and the traps to avoid so your next return is not another April gut punch. Before we fix it, let's zoom in on what's actually causing the pain. If you earn your money as a W-2 earner, here's your life. You work, taxes come out, and you get what's left. You face high taxes, very few deductions, and almost zero control over the timing. That's why your April bill stings so much. The goal of this video is to use real estate to legally create deductions you can actually use as a W-2 earner to lower your taxes you pay now and to stop year after year bleeding and to put that money to work for you instead of the IRS. And here's an important mindset shift. Filing your taxes is scorekeeping. Strategy is how you win. If all you do is file, you'll stay reactive. If you add strategy, you get control over your wealth. So let's switch from scorekeeping to strategy, and the simplest legal switch is real estate. Properties, they wear out. The IRS knows that, so they let you deduct the wear and tear over time. That deduction is called depreciation. It's a paper loss, and it does reduce real taxes. There's a way to speed this up. It's called a cost segregation study. Instead of treating the whole building like one big 27.5 year chunk, you break it down into parts. Things like the flooring and the fixtures, appliances and landscaping, some of which can be written off much faster. When rules allow, you can also bonus depreciate a portion of those faster parts to create bigger deductions moving forward. And this is how you get a larger write-off earlier, which means you have more cash in your pocket right now today. So here's the catch. By default, those real estate losses are considered passive, which usually cannot offset your W-2 income. And that's why many high earners never actually feel and receive the benefit. There are two legal ways to change that. If you meet either one, those losses hit your W-2 income and lower your tax bill this year. Before I show you both these lanes, let's take a quick pit stop. If you're a high earning W-2 earner making over $300,000 a year, you're tired of seeing a huge chunk of your income disappear to taxes, listen up. In the last 12 months, we've helped over 250 clients save over $12 million in taxes using our tax return system. That will 3x your refund this year without changing your CPA, without changing your lifestyle, and without wasting hours on tax planning. Click the link in the description to book your free strategy session, and that's it. Now let's talk about Path A, short-term rental, and material participation. What does this mean? You run a real Airbnb or VRBO yourself, not a long-term lease, so 7 days or less, and you're the one actually managing it. So the IRS treats it like an active business, not a passive investment. And to make the treatment stick, there's two simple rules to apply. Number one, your average guest stay must be 7 days or less. Think weekend and weekly bookings, but not anything midterm, 30 days or year-long tenants. Rule number two, you material participate. You're also known as you're more hands-on deck on that property than anyone else, any other helpers, cleaners, co-hosts, and you're investing at least 100 hours per year on that property. Easy proof to keep: booking calendar, guest messages, checking in and out turnovers, supply runs, contractor coordination, simple time logs to make sure you have the proper records. Why it matters. If you meet both rules, your short-term rental paper losses from the depreciation and cost seg study can be treated as non-passive, so they can legally offset your W-2 income when your return is filed correctly. Now let's look at Path B, real estate professional status, also known as reps status. Often it includes your spouse. So what does this mean? One person in the household makes real estate their main job for the year, managing, leasing the property, acquiring, renovations, etc., and actively runs the rental properties. So the IRS lets rental losses offset W-2 income at this point. So there's a couple tests. Two tests, both are required. The first one is 750 hours in real estate work. That can average out to about 15 hours per week, but at least 750 hours throughout the year. The second criteria is more than half of your total working time is in real estate. So if you're working 20 hours a week at a part-time job, you would require 21 1 hours a week within real estate, plus material participation in the rentals that you are actually deducting, meaning you're actually running them. How do you prove this? Well, you need to show you were the one doing the work. Keep a booking calendar, guest message history, check in and out, turnover notes, supply runs, contractor coordination, and just keep the simple time log. And why does this matter? When you meet both the rules, the deductions from your short-term rental, like depreciation and the cost segregation study, are treated as active losses, which means they can legally offset your W-2 income and reduce your tax bill when your return is filed correctly. The bottom line is both paths are fully legal and proven when you document them correctly. If you can actively manage a short-term rental this year, choose the short-term rental lane. If your spouse can make real estate their primary work, choose the reps status lane. Pick your path and commit. And then let's turn your choice into a simple step-by-step move that can put $50,000 to $100,000 back into your pocket this year, just like our clients are doing. So step one is choose your path. If you want the fastest route, run a short-term rental. That means an average guest stay is 7 days or less and you're actively managing it. If one spouse can make the real estate their main work this year, go the real estate professional route. Pick one path and commit to it. Get a property placed into service this year. And what that means, it's rent ready before the year end, it's furnished, photographed, it's listed, and it's actually available for bookings. If it's not placed into service, you miss this year's deductions. So timing is very important. Timing is everything. And step number 3 is going to be order a cost segregation study. Hire a reputable provider. Hint, hint, my team. We break your property down into different parts: the flooring, the fixtures, the cabinetry, the landscaping, and things that can be written off faster. And that's how you pull big legal deductions forward instead of waiting over 27.5 years, or on commercial properties 39 years. Step 4 is operate and document like a pro. Save everything from your guest messages, your cleaning schedules, your supply receipts, contractor invoices, your mileage to and from the property. Just keep simple hours logged. For your short-term rental, your log should clearly show that you did more hours than any helper or anybody else. For rep status, real estate professional status, track the total real estate hours and your participation. Clean records makes the strategy stick and makes the deduction stick long-term. Step 5 is going to be a clean filing with your CPA. Your tax return must match the plan. The right statements, the right elections, clean books, clean support, the right timing. When paperwork and strategy line up, the savings hold. So do these 5 steps. You'll stop writing oversized checks to the IRS and start keeping more cash every single year. Now, what does that look like in dollars? Imagine you buy a $500,000 property this year. The land is not depreciable. So let's say $400,000 is the building and its components. A cost segregation study might show a meaningful chunk of write-offs that you can take faster from different categories. With the STR or rep status both done correctly, a large legal first-year deduction can hit your return and offset your W-2 income. Remember, this is about real dollars this year, not drip-feeding tiny deductions over 27.5 years. When you keep more cash today, you can move it into assets, investments, paying down high-interest debt, things that grow your net worth instead of shrinking it. So before we lock this in, let's avoid the mistakes that kill the strategy. Mistake number 1, treating a long-term rental like it's a short-term. If your average guest stay is more than 7 days, you miss the short-term rental rule. Keep the average stay 7 days or less. Mistake number 2, not tracking your time. If your cleaner or co-host spends more hours than you lose the material participation. So keep a simple time log, make sure your hours are higher than anyone else. Mistake number 3, missing placed in service this year. If the property is not fully furnished, listed, and available for rent before end of the year, you cannot use the deductions. So get it rent ready on time before December 31st. Mistake number 4, sloppy paperwork, no receipts, no mileage, no participation logs. And what this means is shaky deductions. Save all your invoices, all your log miles, keep guest messages, all the turnover notes, and be as detailed as possible. Mistake number 5, assuming your CPA will fix it come April. Again, filing is scorekeeping. If you don't set the strategy now, there's nothing to file later. Align the plan with your CPA before the year ends. Do these right and your savings will actually hold up. If real estate is not a fit this year, do not force it. But here's how you can still make progress. Watch the video on the next screen. How to legally cut $50,000 off your W-2 tax bill. That video walks you through non-real estate plans step by step. Start a simple side LLC, write off real business costs using HSA, 401ks, the smart way. You could even mix in a backdoor Roth for tax-free growth, bundle giving and donor advised funds. You could prepay legit expenses before the year ends, and know when an S-Corp actually helps so you can cut this year's tax bill the right way. If you are considering real estate industry and you don't know where to find the right deals, when you hire me and my team, we actively have 40 to 50 properties available to purchase for our clients to pick and choose from. If you instead want a custom plan for your numbers, hit the top link in the description to book a free strategy session where we will design and implement a personalized tax saving strategy to 3x your tax return before the end of the year. And remember, smart moves now beat big regrets later. Keeping more of what you earn starts with the actions you take today.